All right, welcome to your financial booklet briefing for Friday, January 30th, 2026. Today, we are looking at a market that is truly at a major turning point. We're seeing some long-term policy shifts create some pretty serious short-term shockwaves. So let's get straight into it. And wow, right out of the gate, the big story is this incredible divergence. I mean, this is a classic flight to safety. You've got capital just stampeding out of newer digital assets and pouring into one of the oldest safe havens on Earth. Gold is rallying, and it's rallying hard, while crypto is definitely feeling the heat. So the big question is, what in the world is driving this huge rotation? Well, the answer really starts in Washington. It's the single biggest macro event on the horizon. We're talking about a changing of the guard at the most powerful central bank in the world. A new face at the Federal Reserve could mean a whole new playbook for the economy, and you better believe markets are reacting to that uncertainty instantly. Okay, let's really dive into this, because this isn't just some minor market jitter. This is a shockwave, and it's starting from a fundamental shift in what everyone thinks is going to happen with U.S. monetary policy. And here's the catalyst right here. President Trump has put forward his nominee for Fed chair, and it's Kevin Warsh. Now, for investors, this throws a huge dose of uncertainty into the mix. Warsh is generally seen as a policy hawk, which, is just a fancy way of saying he might be more inclined to raise interest rates to fight inflation. So the entire market is now scrambling to figure out what that more aggressive future might look like. And the immediate reaction? It's crystal clear. Gold is surging, making a beeline for that key psychological level of $5,600. This just screams that investors are desperate for something they see as stable. And at the exact same moment, the riskier stuff like Bitcoin is facing some serious downward pressure. So let's zoom in on the sector feeling the most pain from this whole shift: digital assets. And look, it's not just one thing, it's more like a triple threat. You've got market pressure, internal pressure, and regulatory pressure, all hitting at the exact same time. The scale of this market pressure is just staggering. We just saw US-listed Bitcoin and Ether ETFs have their worst single day of outflows since last August. They bled at nearly $1 billion. This isn't just a dip, it's a massive withdrawal of capital. The second threat is actually coming from inside the house. When a co-founder of Ethereum, Vitalik Buterin, moves $17 million worth of Ether, people notice. It's seen as a signal, right? It suggests the Ethereum Foundation is tightening its belt, getting ready for more rough seas, and that sense of caution is spreading. And then there's the third threat, a big, coordinated regulatory push. We're talking the White House, the CFTC, the SEC, the Senate. They are all moving together on this. From high-level talks to new joint task forces and new bills moving forward, the message couldn't be clearer. The era of regulatory ambiguity, well, it's quickly coming to an end. But hey, it's not just crypto under the microscope. Let's pivot for a second to big tech, because it is facing its very own reality check. For these absolute giants of the market, the number one question investors are asking is all about valuation. Now, to get what's happening here, we have to talk about a key metric, the price-to-earnings ratio, or PE. And it's actually pretty simple. It just tells you how much investors are willing to pay for every single dollar of a company's profits. So a high PE means people have some really high hopes for future growth. And that brings us to this number, 63. After its latest earnings report, Tesla is trading at a core PE ratio of over 63. That means investors are paying $63 for every $1 of Tesla's repeatable profits. That's a pretty stark number, and it really shows the kind of high-flying valuations that are now getting a very hard look in this risk-off market. And this valuation pressure is being felt all across the tech sector. I mean, chief financial officers are in a really tough spot. They're in the middle of an AI arms race, right? So they have to justify spending billions, truly unprecedented amounts of money on infrastructure, while at the same time trying to convince shareholders that this massive spending is somehow disciplined and a smart long-term bet. That is a very, very tricky balancing act. So with all this turmoil and uncertainty, you might think everything's just grinding to a halt. But if you look a little closer, you can actually see the foundations of the next market being built right in the middle of all this chaos. It's like there are two critical tracks running side by side. On one track, you've got new infrastructure getting funded. You see things like Escape Velocity raising a $62 million fund for DePIN, that's decentralized physical infrastructure, and you've got new products, like Coinbase launching prediction markets. But on the other track, at the exact same time, a new rulebook is being written by regulators.
So innovation and regulation are literally shaping the future market as we speak.
And all of that leaves us with the central question of the day. Are we just watching some short-term turmoil, driven by policy fears and crazy valuations? Or are we actually witnessing the stressful, maybe a little messy, but absolutely necessary process of building the foundation for a more mature, more regulated, and more robust market for the future? That's the story we'll be tracking.